Hello and welcome to Smart Money. My guest on the show today is Sharan Hegde, who needs no introduction. He runs a successful online community, Finance with Sharan, with over, 4 million followers across social media platforms. He also runs the 1% Club, a community to empower people to become financially independent. Now, today we discuss the latest from the SEBI consultation paper urging finfluencers to register if they want to work with regulated entities. But apart from that, I'm also keen to learn how this large and successful community and ecosystem of finfluencers is being used to spread awareness about financial literacy, increase financial inclusion, and how retail investors could benefit from these initiatives. Sharan, thank you so much for joining us.
Thank you so much for having me. It's a
I
pleasure.
remember the last time we spoke was during COVID times.
That's right. When I was in my house.
Yes, and I was in mine.
Yeah.
And you have come a long way since then, so kudos to you.
Thank you so much.
How has your journey been so far?
I think it's surreal. Even I never thought it would grow this big. Honestly, when I began, I thought only a few thousand would be interested to listen about finance on a platform like Instagram. But it's unbelievable to see that now it's millions of people, which clearly indicates that there is a significant need among the people to learn this stuff, and they realize the importance finally.
Absolutely, and I completely agree. I was talking to Anushka Rathod as well in my last show, and she said that earlier 80% of the brands she worked with were startups and 20% were traditional.
Right.
Now it's reversed, so there are 80% traditional and 20% startups, so that's the way to go. But before we talk about, the big opportunities in the financial education space and in wealth management, over the next 5 years, let's just clear the air on this big debate that finfluencers should be SEBI registered in order to give out advice to their followers and community. Now, I want to understand from you, where does the finfluencer community stand on this? And what's the best approach by SEBI where ethics can be maintained on one hand and at the same time this community can grow?
So I personally think it's a very big welcome move by the SEBI to finally recognize finfluencers as an extension of knowledge distribution in this country. And it's a welcome move that unregulated, let's say, finfluencers are not allowed to promote SEBI registered products. Now, talking from a finfluencer business point of view, it doesn't really impact us because 99% of influencers don't really promote SEBI registered products. What I mean by that is, let's say, a specific stock or a specific mutual fund. 99% of influencers don't really directly promote that, right? It is just those 1% miscreants on platforms like Telegram who really, put those fake screenshots, say that this stock is going to go up to this much amount.
And misguide investors.
Misguide investors. So I think this is a welcome move by SEBI to stop that. But I think at the same time, it's very important to realize that finfluencers are of different categories, right? The vast majority of them talk about personal finance, right? It is just the ones which are talking about directly investing in a particular stock or a particular trading initiative are the ones which need to be stopped because they are directly influencing what people are doing with their money in real time. So I think that was a welcome move by SEBI.
Okay. This discussion, of course, has gone on endlessly. And, the SEBI consultation paper is out. There's, of course, going to be a lot of responses to this. So we'll leave that aside. Let SEBI do their job. But I want to discuss what the future of wealth management is because, as you said, right, influencers play a big role in financial inclusion, in financial literacy. And now, as we know, there are 10 crore Demat accounts currently, which is quadrupled over the last 10 years.
That's right.
So tell us, this rising middle class, you cater to a lot of brands as well. What do you see as the future and where are the gaps?
Right. Firstly, it is phenomenal to see the number of Demat accounts grow over the last 2-3 years since COVID and the rise of influencers. But what is currently missing is that people are now aware that there are so many investment products available and there are thousands of them. But what's missing in this ecosystem is somebody to guide those people as to what they should do. Because what they should do is should be very customized based on their financial goals. Now, this is where wealth management comes into play, financial planners. Now, the challenge here is there are two solutions which are available out there. One is by being a mutual fund distributor, who charge you a commission, let's say 1% of the amount that you invested. Now, this 1% might seem less, but over a 10 or a 20-year period, it actually accumulates to 10 to 20% of the money that you have made over a 20-year period. And on the other end, MFDs, mutual fund distributors, they only work with HNIs most of the time because they put in the same amount of time regardless of whether you make 10 lakhs a year or 1 crore a year. So the only thing that's left for the rising middle class today is SEBI registered investment advisors. Unfortunately, there are only 1,300 of them, and through talking to numerous people who are already RIAs, I'm hearing that a lot of them are giving up their license. I hear that only 200 people are actually practicing registered investment advisors in this country. And even if I look at the top 10 cities of India, that's 20 crore people. So 200 people for 20 crore people. So clearly there's a big gap. And the reason being that RIAs are not incentivized. As a financial planner, not many people are incentivized to be an RIA. They all want to be an MFD, because MFD you get to work with HNIs. You get to charge 1% commission. If you are an RIA, you can only take money from the customer. I cannot make money from selling insurance products to you. I cannot make money from selling mutual fund products to you. MFD can, because they get 1%.
But a lot of RIAs also, to be honest, do make money from selling mutual funds and from the mutual fund companies itself.
That is the gray area where they get from their marketing budget. And a lot of them do it, because then it's not sustainable, right?
It's not sustainable,
right?
exactly.
Because they have to hire a person who is at least at a 30-40 lakh package, and they have to charge these customers minimum. The market rate for an RIA to charge a customer is around 35,000 rupees plus GST. That's the market average. How many people can afford that, to pay that kind of money? You should have at least 30 lakhs or 40 lakhs per annum to be able to afford paying 30,000 rupees to a financial planner every year. And so because the market is so small, because you have to charge 30,000 rupees to be viable, and there are no opportunities for you to upsell. So that is why there is a huge problem today, and a lot of RIAs are giving up their license. Every fintech company that I talk to, like 90% of them don't even want to touch becoming an RIA. And that's very sad, because there's a huge demand out there.
There is a huge demand. We were talking about the penetration, right? I mean, with the women folk, I do a lot of these topics on women and financial inclusion. The penetration is so low, it's barely in low single digits, the kind of people that have investments in financial assets. Most women still invest either in gold or have money parked in real estate or in cash. But okay, how can the new fintech companies solve these problems?
I think the challenge for fintech companies is that their CAC is very high, meaning the cost to acquire those customers to offer financial planning services to is so high that even, like for example, I won't name the fintech company, but there's a certain fintech company who spends anywhere from 20 to 25,000 rupees to acquire one customer. And after that, they need to convince the customer to pay me 30,000 rupees. Right? So that is why at the front end itself, meaning acquiring the customer, it's already negative. And after that, I'm not able to upsell other products. So it's like a losing game for most fintechs. So what fintech should focus on is to create their own organic distribution, create content, create channels where they're providing free content to build trust with the audience. For example, in our case at the 1% Club, because for the first 2 years, we didn't have any products or services. We were just creating content, free content, which helps us build trust. Today, our cost to acquire the customer is negative, meaning every customer who comes in is already paying us to come. So we're already profitable there. So that way we can, so the go ahead for the fintech companies is to build your online distribution, build that trust, so that at the front end your customer is being acquired for a very low cost, and then get a corporate RIA license, hire hundreds of financial planners, and offer financial planning services at a subsidized cost. Because when you're at scale, you can reduce the cost. So instead of 35,000 rupees, you can maybe bring it down to 25,000 rupees. So you can bring down the cost significantly.
So what are these companies like, Grow, Upstox, Zerodha? I mean, of course, all of them are largely focused on trading.
Right.
But a lot of them also trying to get into this.
So they can't, right? Because when you are a brokerage platform, you cannot offer advisory services. For example, even IND, they were offering personal finance service, wealth management services. Now they have shifted to becoming a brokerage because they realize that it's very difficult to make money here. So you might as well make money from their trading income. So if you see any successful wealth management company in India, Zerodha, Upstox, Grow, all of them are into trading. Because once a person starts trading on your platform, the LTV, the lifetime value, is so high because trading is sometimes addictive. So the longer you trade, the more money you're making for the brokerage. And that is what's happening in wealth management today.
So you're saying that there is tremendous opportunity, right, for fintech companies in this entire wealth management space. What do you think is the 1, 2, 3 solutions? I mean, what do you see as the future?
Right. The future is that the approach that a fintech company should be different, like I said. They need to first focus on building trust with the audience. Now, trust is built over time. You need to build content. You need to educate the audience. Education is also missing among the audience. People don't really understand the value of paying someone to manage your money. As soon as you ask somebody to pay me money for managing your money, you will immediately ask that person, okay, how much returns will you give me? Will you beat the market? Can you get me 25% returns? If you're not getting me that, I'm not going to give you the money. What people need to realize that financial planning is not about beating the market. It's about allocating your money in the right places so that your financial goals are met. And most people are making the mistake here. Everybody wants to get into trading right away. And more than 99% of them lose money there. So the first that education has to be done, where people need to realize that financial planning is important in their lives. Once that education is done, then it becomes easy to convince customers to pay for that service. So that problem statement in the customer's head needs to be solidified first. So fintech companies should work towards that, and it's a very long game. You cannot do this in 1 or 2 years. No matter how much money you raise, you're just going to burn money if you don't go through the education phase first. So I would say any player who gets into this, it's a minimum 4 to 5 year game.
Okay, well, we'll take a short commercial break, but don't go anywhere. We'll come back. Lots of interesting topics being discussed with our guest, Sharan Hegde. We'll be back in a bit. Welcome back to Smart Money on CNBC TV 18. We are in conversation with Sharan Hegde, popularly known as Finance with Sharan on social media. And he's been discussing a wide range of topics with us. Of course, what the future of the wealth management and the mutual fund industry is. But let's get back to the topic at hand, right? The SEBI consultation paper to clamp down on, I mean, that's a harsh word, but at least to regulate all the miscreants in the finfluencer space, and we must agree that there are many. So how do you see these regulations pan out? In the sense, should there be a separate set of regulations for finfluencers in the personal finance sector? Because, you know, to be very honest, I mean, on this whole trading side, there's so much wrongdoing happening on a daily basis. I agree that this SEBI sort of over-regulating perhaps, but what do you think is the right approach?
I think the way that SEBI has started is definitely in the right direction, because they said this is a consultation paper and they're asking the public for their opinion. So that's the perfect way to start. Now, when it comes to financial products, there are two types. Like when I say giving financial advice, that's very ambiguous. Financial advice could be, from one end of the spectrum, it could be that, hey, purchase HDFC stock at this price right now. On the other end, there could be, hey, use this app to manage your expenses. Big range here. So now when we come to, let's say, SEBI regulations as to saying all influencers should be registered to give recommendations for financial advice. Firstly, we need to figure out what is this ambiguity. What is the breadth of the financial advice that can be given? Now, as per my understanding, it will be limited to products which are regulated by SEBI, which could be stocks, mutual funds, and bonds. 99% of influencers don't even promote that. Okay. Number one. Second thing I would say,
so there's a lot of self-regulation basically happening within finfluencers already.
Yes, because some of the laws are already there. Like, for example, there was a law which SEBI passed that anybody who has more than 1 million followers will be treated like a celebrity, and celebrities are not allowed to promote SEBI-regulated products. So some of those laws are already there before this came in. So it didn't really do any material impact to most of the top influencers. Okay. Right? So that's one angle of it. Yeah. But what about on the other side? Yeah. So on the other side, a lot of people keep asking influencers, why don't you get registered with the SEBI? Yes. I wish it was that simple, but let us look at our options, right? There is either becoming an RIA or becoming a research analyst. Now, a influencer does not fit into both of those categories, because what does an RIA do? An RIA takes money from the customer and gives them financial advice. A influencer doesn't take money from the customer. As long as you don't take money from the customer, it is not coming under the RIA realm. Similarly, a research analyst is the one who studies and analyzes stocks. I would say some influencers do that, so probably they can get a license for that. But for the vast majority of personal finance influencers who talk about money hacks of how to save your taxes, how to plan your insurance, how to do asset allocation, we don't fall under any of these buckets. Now, let's say SEBI comes up with a finfluencer kind of a certification, then yes, we'll go ahead and get it. But I don't think that's going to come. We might be forced to fit into one of these two categories. And RIA seems to be the closest one of them, but I'll tell you the challenge. You need to have a PGDM degree of 2 years, let's say an MBA or a CA. You need to have cleared NISM 10A, 10B exams. And then you should have 5 years serving as a financial planner. So that's 7 years. Right? It's not feasible for a influencer today to give up 7 years of their life to get the RIA exam and then get back into it. That's 7 years. Like, there is no incentive for us to do it. So that is the challenge right now. Okay, the other thing, I take your point. I mean, it's a long, complex process, and since you don't fit into that bucket, it may not make sense. But what do you do? You know, like the other day I was watching a video on some insurance products, and the influencer who was talking about it, at the end of the video said, oh, you know, this is sponsored by, say, an ICICI Pro, whatever, and as an example. Now, of course, I would know the difference, but there are a lot of people who may not understand. They may think that this is a direct, you know, selling of the ICICI Pro products. So what do you do at a time like this? How do you make sure that, yes, you are promoting financial literacy, but at the same time, there is not, you know, a blatant promotion of brands? I think this is a problem that won't be solved even with regulation. And I'll tell you why. I'm sure you're familiar with the Madhya Pradesh RIA scams, right? The group of RIAs, manipulated people to do trading. So these were registered with the SEBI and they did this. So even if you become an RIA, you cannot stop the miscreant from doing stuff like this. So I think this is not something that a regulator can solve for. This is something that a person needs to self-regulate themselves, and the audience need to educate themselves and choose their information wisely. I don't think it's possible, because you cannot just say nobody can talk about finance, because then that would be a violation of freedom of speech. I think the SEBI chairman spoke about that yesterday at the FinTech Summit. So you cannot be as brutal as that, saying nobody can talk about finance. So the only option here is for the audience to educate themselves and not blindly listen to anybody and make their own opinion. They should be responsible for their own actions and should not just blame someone if something goes wrong. At the end of the day, the audience is responsible for investing their own money.
Absolutely. No, I agree with you. I mean, when you read the paper as well, right, there are blatant ads all over the place. It doesn't mean you go out there and buy everything.
Absolutely.
You make your own decisions. I take your point. Okay, that's enough about all this, the SEBI consultation paper. We have just a couple of minutes left, and I thought, let me ask you about your own journey, Sharan. I mean, it's been remarkable, the kind of growth that you've seen. And I'm sure a lot of our viewers want to know some hacks, in not just content creation, but in building the social media personality. What has your biggest learning been?
I think the biggest learning is knowing how to simplify things, right? I mean, I think that is my, biggest skill. That how do I take something which is very complicated and then break it down into simpler things, so that when I explain that to, let's say, a 15-year-old kid, that person understands it. Like today, I'm seeing a rising number of teenagers coming up to me and saying that they learned this, that, and this, and they are no business learning all that because they don't make money, but they're already so excited. Recently, I got a LinkedIn post from someone who said that he attended my masterclass with his son, who was like 10 years old, and that person understood a lot of things. So I think the greatest learning is to dumb it down as much as possible, because people don't want to hear complicated jargons. You might think that it makes you look smart and sophisticated, but if you want to truly impact and educate people, you need to make it simple. There is no,
There's no other way around.
There is no pride in using complicated terms and pretending to sound like you're smart. Dumb it down so that everybody can understand, and that's the secret.
Absolutely. I mean, I take your point, and kudos to you for doing that. And I must say, we started this discussion, you were telling me as to how, you feel like sort of people are against you, and there's a lot happening that's, against the whole influencer community. But I must tell you that you're doing a great job promoting financial literacy. I believe that, financial literacy should be taught in schools.
Right. Which
is not done. I hope someday they will, SEBI has taken that up as well.
Right.
As a part of promoting it in curriculums in schools. But kudos to you, congratulations, and I'm sure you have a long way to go. Any final thoughts before we let you go?
I think most people take financial literacy, I would say, casually. Most people, they think that I can focus on this once I make a lot of money. But I would like to tell the people that more than, starting to invest, it's about the discipline that you build, and it takes a lot of time. It's very easy to say I'll start investing once I get married and have kids, but that initial push to start, like for most people it's difficult to study after you graduate, right? 5 years later, if I ask you to study something, you can't make yourself study after some point of time. So the earlier you start it, the better. That's the only advice I would like to give. Earlier the better.
Earlier the better. This brings me to that book, Psychology of Money. I'm sure you read it, where they say that Warren Buffett, of course everyone tries to learn from him, right? They say he started investing at the age of 10.
Right.
You're talking about the 10-year-old who attended your class with his father, and 80% of his wealth was created after the age of 65. So that's the kind of time you need to give in the market if you want to create generational wealth, I guess.
Yeah, it's all about creating a machine, and once it becomes a certain size, it runs on autopilot. And most people don't let the machine be big enough because they keep sucking money from that machine, so it doesn't become a self-sustaining machine which makes you more money. So that's the only thing. Okay,
Sharan, thank you so much for joining us, and I hope this community continues to thrive, continues to survive, and at the same time, I hope SEBI puts in some proper rules and regulations in place to prevent miscreants. Thanks a lot for joining us.
Thank you so much for having me.
All right, with that, it is a wrap on another edition of Smart Money. Keep writing to us. We love receiving feedback from you. Till we meet again, have a great weekend.